Hey guys, so let's tackle the accounting treatment of government grants. So with government grants, we get different forms of government grants, and as a result, each form will have its own accounting treatment for it. So let's first investigate the different forms of it, and then we'll look at the supporting treatment for it. So we know with government grants, it entails a transaction with the government. The first type of transaction that you can get is where a government will give you income in order to carry out and satisfy the conditions of a grant. This income alone will be known as an income-based grant. And as a result, we can present this income-based grant in one of two forms in our statements. The first form is known as the separate credit method. This entails disclosing the realized portion of the grant separately from the expenses. So we know, according to the standard, that we have to realize a portion of the grant on a systematic basis in accordance with the cost. And the cost will be related to the conditions of the grant, to satisfy the conditions of the grant. So as a result, income that we realize in the period will be disclosed under other income at 100% of the realized portion. And the expenses will be disclosed separately under the expense line item, and that will also be at 100%. This is typically disclosed then in the statement of profit and loss and other comprehensive income. That's the first way to present it. The second way to present it is the offset method, which means what it means. In other words, we are going to offset the income from our expenses. So we are going to reduce our cost. As a result, when we present it in our profit and loss statement, we are not going to have an other income line item because that would have been used to offset against the expense. As a result, the expense line item will be a lot lower. So that's the income-based grant. Another transaction that we can have will entail an asset. When we have an asset, then it will be related to an asset-based grant. Now there's one of two ways we can have an asset-based grant. The first transaction is where the government will actually give us an asset in order to satisfy and carry out the conditions of the grant. This is known as a non-monetary asset-based grant, because it just only relates to the asset. Now there's one of two ways we can bring this value on into our books, because we have to bring the asset into our books. The first way is known as, we bring it at fair value. Now this is the preferred method, according to the standard as well, and how we typically account for our assets. The second way to account for this is at nominal value. Nominal value, which is the same as the cost of the asset on the day we receive it. But it's less common, less likely that we'll actually use this method. The second type of transaction relating to an asset that we can have is where a government won't have the asset, but we do require an asset in order to satisfy the conditions. So typically what you would find in a scenario is that on day one, the government will give you the money, where you have to then take that money and go and purchase a grant. This is still an asset-based grant, but this is also now known as a monetary asset-based grant. Monetary grant. For this, just to separate it, for this, there's also one of two ways to present this. The first way is known as, the deferred income method. So the deferred income method also states similar to that of the separate credit method, where we're going to account for our income separately from our expenses. So the income will still go to other income, and our expenses will go to the other expenses line item. But what would the expenses typically be in this situation? The expenses will relate to an asset, and we know the expenses of an asset is depreciation. So therefore, we'll realize then we'll have depreciation at 100%, and then the income that we realize will be taken to other income. That's the first presentation method. The second presentation method is known as the offset method, which is also similar to the income-based grant. So on the offset method, what we'll typically do, on day one, when we receive the grant and then we go and purchase the asset, what we'll do is we'll reduce the cost of the asset by the value of the grant. As a result, when you reduce the value of the asset, it will then lead to lower depreciation in the future. So it's the same as our income-based grant where we have also a lower cost. That's what we're trying to work towards, to have a lower cost, because we want to offset our income against our expenses. In this situation, by reducing the cost of the asset, we're also reducing the expenses that we're going to realize every year. And that's going to lead to lower depreciation in our statements of profit and loss. So that's the income-based side. The third form of grant we can get is a loan-based grant. So this will mean we'll have a transaction with the government that entails a loan. So the first form of loan that we can get is a low-interest loan. This means that the benefit we're getting between the rate that we have with the government and the market-related rate will be the grant portion. So in other words, if the market-related rate is 10% and our grant entitles us to a 3% interest rate, the difference of 7% is a benefit to us, and as a result, that benefit will be accounted for as a grant. The second type of loan-based grant will be a forgivable loan. So this typically will entail where we have a loan with the government, and then somewhere along the lines the government will decide to waiver the entire loan, whether it be both the capital and the interest portion, or whatever portion or combination of the portion will be. Whatever the government waivers with us is a benefit to us. That benefit is known as a grant to us then. So these are the three common types or three common forms of grants we get, as well as the presentation methods for it. So let's have a look at the accounting treatment for each form. So let's work with an income-based grant. So on an income-based grant, on day one, which is initial recognition, when we receive the grant, regardless of which presentation method you elect, the journals on day one will still be the same. Now remember, on day one we receive the income. When we receive income, it's going into our bank account. So we need to increase bank by debiting it, statement of financial position. And what would be our contra? Now we're receiving this money, but we haven't earned this money as yet, because we need to satisfy a set of conditions before we actually earn this money, before the money belongs to us. But until that point in time, it's a liability because it doesn't really belong to us. So on day one, we also need to realize, or we need to bring this liability on board. So in order to bring a liability or raise a liability, you credit. In this case, we'll be crediting government grants, deferred income, statement of financial position. And this is day one for both types of presentation methods. Now, as you go about throughout the year, you will then, by the end of the year, realize a portion of your grant in relation to that of the cost. Remember, income must be recognized or realized on a systematic basis against the cost. So still working on an income grant, subsequent measurement. Remember, there's two ways you can then elect to present this. The first way is the separate credit method, or we can then elect the offset method. On the separate, regardless of which presentation method you elect, you are going to incur expenses for this grant. So typically, if you had to go, we have to record the expenses, it'll be debit your expense, credit bank or creditors, whatever the case may be. So you still record the expenses as normal. On the separate credit method though, we said that we're going to realize our income separately. We're going to disclose it separately from our expenses. So because we are disclosing our income separately, we will credit the other income, statement of profit and loss. And what would be our debit? Remember, on day one, we recognize this liability and we said this liability doesn't belong to us. The money from this liability doesn't belong to us. But as we satisfy the conditions throughout the period of the grant, we will realize a portion of this grant and it becomes our money. And this is where we are realizing it. We are taking it to the income side. But because now we are realizing it, we have to reduce our grant. We have to reduce our liability. To reduce a liability, you debit it. Debit, government grants, deferred income, deferred income, statement of financial position. That's how we realize and take it directly to the other income side. But what happens when we have the offset method? Remember, with the offset method, we said that we're going to reduce our expenses. We're not going to have this other income side. So on the offset method, we would then credit our expenses. Remember, first of all, we are going to record the expense side, regardless of the separate credit method or offset method. In both instances, we're going to have the expense. So we're going to record the expense at 100%. And then on the offset side, we need to decrease the expense now. So to decrease an expense, you credit expenses, statement of profit and loss, and you debit. Well, what would you debit? Remember, we said we're reducing the expenses by the income that we're going to realize, which will essentially be similar, the same amount that we would have on a separate credit method. So then we debit government grants, deferred income, and the reason being, in this instance as well, we are realizing a portion of the grants, which means we have to reduce our liability because a portion of that liability belongs to us now. So we don't owe as much anymore. Therefore, you debit the government grant to decrease that, and you credit expenses to reduce the expense by the income that you'd realize for the year. So that's on the income-based side, or the income-based grant. What happens when we have an asset-based grant? Now remember, with the asset-based grant, we said that you can either have the monetary or non-monetary grants, where either you receive the asset or you receive money to go purchase an asset. So let's use the example of the monetary side, where we receive the income and we need to go and purchase the asset. So on day one, we are still getting our grant. It's coming into our bank account. So we would have debit bank, statement of financial position, and credit, well, we have to raise our liability now. Government grant, deferred income, also statement of financial position. That's day one. Now remember, typically by the same day or the next day, you would then take this money to go and buy the assets. So we need to bring on the asset into our books. So to bring on an asset, you debit the assets, statement of financial position, and you credit, well, you're paying it out from your bank account. So credit bank, statement of financial position. These two journals is what you do on the deferred income method. Remember, we said for the deferred income method, you're going to keep your income separate from your expenses. So as a result, we are keeping our liability separate from our asset as well. But what happens in a situation where, remember, we're looking at this side now. So the deferred income method is where you have those two journals. What happens if you have the offset method? You elect to choose the offset method. On the offset method, we would still have both journals as well. But now there will be a third journal added to it. Because remember, the offset method, we need to now reduce our asset by the value of the grant. So this would entail, well, if we're reducing our asset, we're crediting our assets. Credit assets, statement of financial position. And debit, well, we need to offset the asset by the grant. So the entire grant amount now is going to be removed. Remember, we initially recognized the grant over here. We raised the liability. Now we need to remove the liability per the offset method because we want to offset it against the asset. To remove a liability, you debit government grants, deferred income, statement of financial position, which then entail will just lead to a lower balance of the asset. Well, what will happen subsequently to this? Now, we know for the separate income, for the deferred income method, let's look at the deferred income method first. For the deferred income method, we said that we are going to keep our expenses separately from our income. So let's go and do the easy part first, being the expenses. We know the expenses here will relate to depreciation. So debit our depreciation, statement of profit and loss, and credit our accumulated depreciation, statement of financial position. And now this will be on the deferred income method. Our asset is still at 100%. Remember, we only processed these two journals on the deferred income method. As a result, our asset is still at 100%, which means our depreciation is also at 100%. But now we need to realize a portion of our income on a systematic base. And we're taking now this income directly to other income. So therefore, this is the expense side. We need to also bring in a journal to account for the income side. Income, we credit our other income, statement of profit and loss. And remember, we still have this liability as well. Because for the deferred income method, we still have the liability as well. We need to now reduce this liability because we are realizing a portion of it. To reduce it, we would debit the liability, debit government grants, deferred income, statement of financial position. So both journals relate to the deferred income method. Well, what will happen if you have the offset method? Remember, with the offset method, we now said that there will be these two journals as well as this third one. And the third one reduced the value of the asset. Because we reduced the value of the asset, we're not going to have the other income component in our statement of profit and loss. We're just going to have one line item, which is the expenses, which is going to be reduced because it was reduced by the income. In this situation, it was reduced because the value of the asset reduced, which will then lead to a lower depreciation cost. So there will be no recording of income, just only recording of the expenses, and we already satisfied from day one that the expenses are going to be lowered. So debit our depreciation, statement of profit and loss, and credit our accumulated depreciation, statement of financial position. But these, for the offset method, are lower than our deferred income method. And those are the accounting treatments for the different form of grants.